Okay, this part we will discuss about the Dinla, the past paper question Dinla, part B and C, which is the focus is on the creditors as well as the financing, including the Islamic finance and the conventional finance. So let's go through part B first. For part B, the requirement is to discuss the connection between the relative cost of sources of finance and the creditor hierarchy. So here are some things that we need to focus on these questions. First of all is the relative cost of sources of finance. In other words, sources of finance including what? Sources of finance including, for example, secured debt, including unsecured debt, including preference shares, and including ordinary share. Okay. Here, what we call is the sources of finance. Okay, the sources of finance including secured debt, including unsecured debt, including preference shares and ordinary shares. And the question asking is about the relative cost of sources of finance. In other words, is whether the cost of each source of finance is the focus is about the cost. So what's the relations that we need to focus is the relation between the source of finance and the creditor hierarchy. So what is creditor hierarchy? So creditor hierarchy, this term is the order in which financial claims against a company are settled when the company is liquidated. Okay, so here we understand two concepts. First of all, it's about the sources of finance. In other words, we know secured debt, unsecured debt, preference shares, and ordinary shares on one side. The other side is about the creditor hierarchy. For creditor hierarchy, okay, it has a definition. It's about the order in which financial claims against a company are settled when the company is liquidated. And remember, for different source of finance, they have different orders of financial claims against a company are settled when the company is liquidated. So, for example, if a company is liquidated, who can have the priority to have the fund to claim the claims when it's settled? First of all, is okay. I'm not saying about, for example, the auditors or those liquidator or professional services or the employees. First of all, it's about the first sources of finance. Also, because it's really about the source of finance. So, who can claim the company first? Okay, should be the secured debt holders, right? The secured debt holders should have the right to claim the company first. And next is unsecured debt holders. Okay, for unsecured debt holders, they have this the right to claim after secure debt holders requirements are satisfied. Okay, for example, for this is for the security holder, debt holders have the claims about $100, and they can take the all $100 from the company first, and then if any balance after the security debt holders claim, the unsecured debt holders can claim the balance, and if there is any balance left after the unsecured debt holders claims, then it goes into the preference shareholders claim. So the next is the source of finance is the preference shares. And the last one, or have the lowest priority to claim, is the ordinary shareholder. Okay. And from this chart, we all know that for the cost, which is the lowest cost, should be the secured debt because it requires the least compensation for the risk to be borne. Okay? Because for secured debt, it has the first priority to claim, to have the financial claims against the company when it's liquidated. So in other words, the risk is lowest and it has the least compensation from the risk to be borne. So the cost is lowest as well. So cost is lowest. And it increased. It increased because they have the financial risk increase as well. Okay, when a company has operation problem and its gearing ratio is high, the financial risk will become higher and higher for example, for the ordinary shareholders and preference shareholders, because they have less opportunity or less chance to claim back if the company is liquidated. So they require a higher return to compensate that risk. They require higher return to compensate financial risk. Okay, because they have no priority to claim against the company when it's liquidated. All right. So here I explain the connection between the sources of finance and the creditor hierarchy. So it's about the risk to be borne by different type of providers of sources of finance. Okay, move to part C. Part C is about Islamic finance and conventional finance. So your requirement is to explain the differences between these two items. So you have to understand well between them, and here is a simple chart showing Islamic finance and conventional finance. All right. In Islamic finance, okay. Both the providers of finance and the user shares the economic benefits. Okay, so they need to share the economic benefits for both providers and the users of finance. It's principle of Islamic finance. Okay, because it is concerning about the benefits of the economic activity, and not only to, for example, not only to the benefits, not only to the providers and also to the user as well. So both parties should be benefit or should share any advantages from these financing activities. Okay, and for wealth creation under Islamic finance is about the risk and reward, and the principle is to share between the user and the provider. And economic benefits. What is economic benefits? Economic benefits includes wider economic goals such as increasing employment, okay, and social welfare. So he has a wider economic goals as compared to conventional finance. Conventional finance has no such requirements about the economic benefits, such as employment, increasing employment, or social welfare. So it just conventional finance refers to the finance which is not based on Islamic principles, okay, and just conventional in the financial system. Okay, there's no requirement on sharing risks and rewards. Between the provider and user of finance. Okay, so conventional has no such requirement. And next difference is about the riba. So for Islamic finance, there's interest or riba is forbidden. Okay, but for conventional finance, this is very important because interest is the reward. It's the reward for providers of finance. Okay, for conventional finance theory, interest is very important because it is the reward for the provider of finance. But in the Islamic finance, it is immoral. So interest is forbidden. Okay. And the last point, or the third point that can be explained between Islamic finance and conventional finance is about the link. It's about the link. The second and the third one is about the link with underlying tangible asset. Okay, in Islamic finance, because it is a support to the business activities which are acceptable under Sharia law, which is the law has a wider scope of benefits like increasing employment, social welfare, and in Islamic finance, it also has one key point is about the underlying asset. It has the direct link with underlying tangible assets such as sukuk. Okay, such as sukuk, it must have a direct link with underlying assets. But for conventional finance, okay, even it has debt, but it may not have any link to underlying asset. Okay, remember for the Islamic finance, there's a sukuk, there is other type, murabaha. Okay, for this type, this type of Islamic finance, the rewards from the underlying assets may be shared between the provider and the user of the finance or maybe only for the provider of finance they can enjoy the benefits from the underlying assets. But in for the conventional finance, because the debt providers or the finance providers enjoy the interest and the debt, sometimes they are not linked to underlying assets. So here are the differences between Islamic finance and conventional finance. So it's only about 4 marks. You have to spend about 7 minutes to complete, 7 to 8 minutes to complete these discursive questions, in which the key point you have to mention is about whether the principle, the first is about the principle. Okay, the principle, Islamic finance is concerning about the economic benefits as wider scope, and the providers and user of the finance should share the economic benefits. And for conventional finance, there's no such principle in this aspect about the risk and reward sharing. For next is about the interest or the riba. For Islamic finance, it is forbidden, but for conventional finance, it is the major income for the provider of finance, and it is also the cost of the for the borrower. And for the third one, it's about the asset, the underlying asset in Islamic finance is linked to with the underlying asset, underlying tangible asset, and for the conventional finance, sometimes it has no link with the underlying assets. So here we finish Part C as well.